Hello, everybody. Jerry Demaio from MortgageZoom.com and Family First Funding. And the topic for today is the 2-1 temporary buy down program for VA, FHA, and conventional mortgages. But first, I'm going to ask, please, as always, subscribe to my channel and please don't forget to like this video. And so, no surprise, mortgage rates are at 20-year highs right now. So programs are coming out of the woodwork. This is not a new program that we're talking about. This is a program that was sort of put on the shelf for many years and is back now to help buyers keep homes more affordable and help sellers sell more homes or agents sell more homes um, and keeping home more affordable. So how does this work? 2-1 temporary buy down means this is not an adjustable rate mortgage. This is a fixed rate mortgage, 30-year fixed rate mortgage. Let's use an example. Let's say the starting rate is 6.5%. We'll just use that as a number for now. In year one, your rate will be 4.5%. In year two, it will be 5.5%. And then year 3 through 30 goes back to 6.5%. What we're trying to do with programs like this is to buy the buyer's time for mortgage rates to come back down so you can refinance the loan before you would ever pay the 6.5% rate. So, how is this structured and who would this work for? So let's talk about who this program would work for. If you are an agent or a seller with a listing that is starting to sit on the market and you're considering a price reduction, you may want to put in the listing. Seller is offering, instead of lowering the price, you may want to put in the offer. The seller is offering to fund a 2-1 buy down for any buyers for this house. If you're a buyer and you're looking to way to bridge a gap between now and when rates level off, you you may want to put an offer and ask the seller to contribute to a 2-1 buy down. Now, the only way to do this is if the seller contributes the money to the buyer. The buyer cannot do this 2-1 buy down with their own funds. So let's go to I always say videotape, but let me share my screen for a minute. So let's use an example for now. So let's say you were buying a house for 500, putting 20% down and borrowing 400, and we'll use 6.5% interest rate. So, as you see, as we discuss, year one, the rate is 4.5%. Year two, the rate is 5.5%. And then year three, it goes back to 6.5%. So in year one, you would have a $501 savings. In year two, you would have a $257 a month savings. So what's going to happen in these scenarios is you take $501.53 times 12, and it comes to $6,118.37. And year two, it's a $3,085.39 savings with a total subsidy of $9,103.76. So, so in this scenario, in this scenario, um, if you were going to offer 500,000 with a loan amount of 400, you would need to be asking the seller for a $9,100 seller credit to temporarily buy down your mortgage for the first 2 years. It's called a 2-1 buy down program and must be funded with a concession from the seller. Again, this must be funded with a concession for from the seller. So I had another client said, Jerry, um, they're asking $500,000 for the house. But in but when I'm looking at the payments, 500,000, my payment's just too high. I really am not comfortable with that payment. So I'm going to offer 485 instead. I say, "Okay, great, Mr. Buyer, Mrs. Buyer. So that's only going to change your payment by 75, $80 a month. You would be better off in a scenario like this. Instead of offering 485, you may offer 495 or 500 with a credit from the seller to cover your buy down. And again, you're looking at, on a $450,000 loan, anywhere between a $9,000 and $12,000 contribution from the seller to help offset your mortgage for the first 2 years. Why is this so important right now in this current environment to try to save some money for the first 2 years? It's important because, listen, again, rates are at record highs, but we expect, the markets are predicting that in the next 12 to 24 months or less, that rates will come back down and you'll be able to refinance into the current market. There's no restrictions on refinancing while you're in a 2-1 buy down program. Okay. Now, you still have to qualify for the mortgage based on that full rate, that start rate of 6.5% in the scenario we gave. You still have to qualify for the mortgage at a 6.5% rate. You cannot use this program to help you qualify for a loan. You can use this program if you already qualify, but you're trying to make it more affordable for the first 2 years until you get a chance to refinance the property. Again, there's never a guarantee that you'll be able to refinance, but again, when rates are at record highs, we're expecting things to change in the next 12 to 24 months or less. So one question I get, and this is a good thing. So your seller contributed, let's say, $12,000 for this 2-year 2-1 buy down, and in 7 months you're able to refinance, and you've only used $4,000 of that money. What happens, Jerry, with the other $8,000 that was put on the side for my buy down? If you were to refinance, that money is actually going to be, the money that's left over is going to be applied to your principal, and it's going to lower your payoff when you go to refinance. So that money doesn't disappear. If it's not used if you're refinancing less than 2 years and all that money's not used, it will be credited towards your payoff and reduce the amount you owe on the house. So if you have any questions about this 2-1 buy down program and want someone to just ask questions and we could do a one-on-one, go to www.mortgage-zoom.com and we can have a one-on-one appointment just like that. Or give me a call anytime. Log on to Family First Funding site, give me a call, go to Mortgage Zoom, give me a call. I'd be happy to review this program with you. Thank you again for joining. This is Jerry Demaio from Family First Funding and mortgage-zoom.com. Have a wonderful day, and let's find you a way to help make a home more affordable.